portfolio optimization under certain assumptions on the market, like market crashes and other things. Feel free to ask questions. So if there's some mathematical object technique which you have never come across or so, ask, and Ralf will give a little introduction or intuitive explanation or something like that. So please ask. As you come from various backgrounds, I know there's mathematicians among you, there's economists, econometrician, and so on. So please ask before you get lost in technicalities. And then we have enough time. We have a morning session now. We have an afternoon session. We have discussion time. So there's enough time to ask questions, and also during the lecture, of course. Okay, so I give the word to Ralf Korn.
Okay, so thanks, Christian, for the nice introduction. It's my very first time at St. Andrews, and I'm very much impressed by the place here. But I'm already 12 minutes into my talk, so I should start without having a lot of introduction here. What you see is I'm a member of the University of Kaiserslautern of the Math Department, and my second affiliation is the Fraunhofer Institute for Industrial Mathematics, and that's an institute which is partly state financed, say for 25%. And the remaining money that they need, they earn by doing consultancy for the industry. So there is also one group, one among 8 groups, that does consultancy for the finance industry, which I founded. So I'm also related to industry. But today, at least in my first part, this is something which is a bit more academic. In the afternoon, I will give you some applications of what you learned this morning. But this morning, we're looking at optimal portfolios and basic methods in the continuous time setting. So not Markowitz stuff, it's continuous time setting. I will show you the 2 main approaches to solving the problem. First, there is the so-called Martingale Approach. And second, there is the so-called Stochastic control approach, which is the older one. And both still can be justified to use. They both have advantages and disadvantages. And we will see. And as Christian told, feel free to interrupt me whenever you like, and then we see what goes on then. Okay, so here we are. As you see, I've got 4 points this morning: a slight introduction, setting up the market setting, and bringing us all to the same background, and then the methods. Okay, here we are. Optimal investment is maybe the most natural problem when you think about investment, financial markets, and other things like that. Why are people investing? Well, they want to earn some revenues, they want to make money. So it's a kind of classical problem. But portfolio decisions, asset allocations, they are much older than financial markets. So in ancient times, 3,000 years ago, the Babylonians already told about diversification. So they didn't use that word, of course. And they didn't diversify into house cash and say education, but they said something like invest into the place where you're living, then keep some precious metals that you could interchange, or spices that you could interchange immediately to have some liquidity. And of course, they invested in their production tools, like a plow or other kind of tools. So they already knew about diversification. That's something which is a good basis. Oops, other way around. Then in the literature, you sometimes meet the aspect of diversification, like in The Merchant of Venice, when the merchant himself, when he talks about his strategy, that he does not invest in just one ship, in just one period, or into one business. And that's what he says, that's why his business makes him happy, which says, well, I of course take some risk, but I don't invest too risky at all. I diversify. And in the book Don Quixote by Cervantes, there are some popular sayings like, you do not put all your eggs in just one basket. It's clear, if you have some eggs and if you let them drop, then they are destroyed. If you have 2 baskets, at least say half of them is preserved. So there is a kind of common sense that investment or asset allocation decisions should be, well, stretched out. Avoid having too much risk. Then in the 50s, there is the well-known mean variance approach by Markowitz. And Markowitz, 40 years later, earned the Nobel Prize for economics. And the question is, well, why that? When I first told that mean variance approach to my wife, and she's also a mathematician, she said, well, for that basic stuff, someone gets a Nobel Prize. And indeed, the mathematics is very basic, but it's the idea behind it. And the idea is, before Markowitz, people, when they did investment, they were looking at the market and said, oh, this is a very nice stock, I buy it, put it into my portfolio, I forget it. And then they looked at the market, at the rest, oh, this also is a nice stock, put it in the basket, forget it, and so on. Now, what counts at the end of the year is not that there is one or two nice stocks in your portfolio. What counts at the end of the year is what's the sum of all of them. Yeah? It's the total, it's the wealth. And the wealth, which is the sum, is of course also affected by how good are they going together? What are the correlations? And Markowitz was the first one who looked at the portfolio return. That was one thing. And of course, as he already had this idea of diversification in mind, he said, well, it's not just the expected portfolio return, it's also the risk that we have to care for. Therefore, he looked at the simplest possible risk measure, the variance, and tried to balance this out between the balance between risk and return, between mean and variance of the portfolio return. That was in the 50s. Since then, the scientific state of art has rapidly increased. In the 70s, or the late 60s, beginning of the 70s, Merton came up with introducing so-called multi-period stochastic control methods, Hamilton-Jacobi-Bellman equation methods. Then in the 70s and the 80s, there were the Martingale methods, duality approaches. You have variational inequalities. You have all kinds of difficulty and generality in this area that you would like to have. But, before I explain all those technical terms, but the practitioners, they still use some kind of one-period Markowitz stuff. They modify it by replacing the variance by value at risk or shortfall risk, expected shortfall or whatever. But still, if you go to practitioners, they use more or less one-period models. And of course, here, the aim of this workshop is, I would like to give you an introduction into those more recent, more modern methods, and in the afternoon would show you how to apply some of those to problems which are close to reality. You will also learn that there's a natural reason why those academic results have not been carried over to the application so far, but we will have a look at that when we are there. Okay, so that's the setting for optimal investment, and now we make a big jump forward, and I'm going to show you the market setting and the portfolio problem. What I'm looking at here is, I'm looking at a classical, well, Black-Scholes type market. You see here, there is a bond, which more or less is a money market account. There are stocks, which have prices that are block normally distributed. And maybe for the first time I use the visualizer here. Whoops. The solution of the equations, it's this thing. The solution of the equations for my bond price, and if I'm just in the case of n equal to 1, okay, nearly visible, then the solution of the equation dp1 of t, p1 of t equal, well, b dt plus sigma dwt with this starting equation. This is the most basic stochastic differential equation that one knows. This is just p1 of t. This equals p1 times e to the power b minus 1/2 sigma squared times t plus sigma w of t. This is maybe that formula that we need sometimes today. This is the formula that you should know. Well, at least you can verify with Ito's formula that this actually is the solution of that differential equation. And Therefore, we know that although I use differential notation here, these things always have a unique solution. Another thing, W is a Brownian motion. I've simulated some path of the Brownian motion here. Brownian motion starts at 0, yeah, every pass here. And if you would fix a time, say the time at 1/2, and would simulate one pass after the other, and then look at all those values which are here, then you would see at this fixed time, it is normally distributed with expectation 0 and the variance of 1/2. So it's linear, the variance in time. It has continuous parse. This is what you see. These are continuous functions, the blue one, the green one, the dark blue, and the brown one. And they are very strange, very irregular, right? And this irregularity can be made more precise in mathematical terms. Brownian motion as a function of time is nowhere differentiable. Yeah? And if you would measure the length of the path, it's always infinity, no matter how small the interval. Now this sounds very academic and very mathematical, but the nowhere differentiability, the use of such a process, can be justified by economic arguments. And why that? Now, if this Brownian motion here would be nice and smooth, and the solution, this solution here, yeah, with a nice and smooth Brownian motion, then the whole process would be nice and smooth. It would have a derivative, and if some process has a derivative, you know at least locally if it goes up or down. If you would know that this process would go up or down, then you would already know how to invest, right? Then you would know that the stock price will increase for certain or decrease for certain in the next time instant. So if this would be the case, everyone would do the same, but there would be no trade at all. And therefore using a process which is nowhere differentiable is a natural thing. So it's not a mathematical aspect, it's a natural thing to use that. Okay, so as you have a solution of that, you know how the evolution of the stock prices is. We now have modeled the price evolution. The next thing is we model the traders. And our trading activities, well, we've got two different possibilities what a trader could do. A trader could rebalance his holdings, shift money from one asset to another. This is modeled by the so-called trading strategy here, which is the numbers of shares of security I that the investor holds at time I, the easiest possible description of his action. And then there is the consumption process or consumption rate process. This is not the actual consumption, it's just the change of consumption between two time instants, or the velocity of consumption. If I'm now adding up all my holdings, phi I of t multiplied with the prices, then I get what I'm owning at time t. This is called the Wells process. Okay, now I have told you how I describe the actions of my traders, but of course my traders should behave in a kind of natural way, right? If they trade, well, they should really realize their losses or their gains, and there is no secret money coming from outside, and there is no secret money disappearing, and therefore one is looking at a so-called self-financing strategy. And self-financing means that I'm starting with this amount of money, x0, and then my wealth changes only due to gains or losses from investment. So this is number of assets held times the price change. So these are the integrated, accumulated gains or losses from stock and bond investment between time 0 and time t. And of course I have consumed that much money, so my current wealth today equals the initial wealth plus gains, losses from investment minus the consumption. That means self-financing, and that means all my money has to be invested at time t, or I can consume parts of it. That's a very natural thing, a very natural requirement. Okay. Another thing which is very natural is that I assume my traders that they don't have knowledge of the future. And in mathematical terms, this means that the stochastic processes describing the trading strategy and the consumption rate process, they have to be previsible or progressively measurable. You are not allowed to look into the future. Your only information is the observation of the prices of the past until today. That is where your decision should be based on. Well, I said also there are some suitable integrability conditions. Well, they should just ensure that you could write down those integrals. That's all. Okay, now, this is of course a nice description, but it turns out that it's not very handy, because it is quite hard from that description to go to that. And this is always multidimensional. You always have those n+1 shares inside, and I want to reduce that for mathematical convenience. And therefore, I'm introducing the so-called portfolio process. Now, what is a portfolio process? The portfolio process simply tells you the fraction of wealth that you invest in stock number I at time t. And as you know that this is the trading strategy, the price is observed and you should know what your wealth is. You could just put that to the other side. Then you've got here the money invested in stock I at time t, and here the money invested in stock I at time t. So describing your strategy by either the trading strategy or by the portfolio process is totally equivalent. From a psychological point of view, using the portfolio process is much more clever. Because think about talking to your neighbor that you don't like because he always, well, pretends how rich he is and how much money he invests into certain shares, and then he says, well, I just reshuffled my holdings and now I've got 1.5 million in NatWest shares or whatever. And then you say, oh, that's a good decision. I also have 40% of my wealth invested in NatWest. Who cares that it's only €400 or £400 or whatever? But it's much more clever to talk about fractions than to talk about absolute values. Okay, so I said that we then obtain this stochastic differential equation, the so-called wealth equation for the wealth process. And it's quite instructive to derive that. Therefore, I write a little bit on the visualizer also. So, here we are again. Oh, this is it. So, if we follow a portfolio or a trading strategy, phi, and I do that with just n equal to 1 to save some of the notation. If I have a trading strategy phi, and this is self-financing, then it says the change in the wealth can only be due to gains, losses from investment, or due to immediate consumption. That is just the condition of self-financing. Okay, now what I'm doing is I'm using the explicit representation of those two, which then is phi 0 of t times p0 of t r plus phi 1 of t p1 of t b times dt plus phi 1 of t p1 of t sigma dwt, well, minus the ct dt. Yeah? I've just plugged in the equations for the bond and the stock price. Now what I'm doing then is I'm using that equality that I have here, that pi of t. This is just, well, phi 1 p1 divided by the x process, and of course the remaining fractions, 1 minus pi of t. This is phi 0 p0 divided by the x process. If I have this, then you see that this here, no, that's the wrong pen, that this is just, well, r times 1 minus pi of t times x of t. So the r is from there. This here, again, is plus pi of t, x of t, multiplied with the b, with the dt. The same thing there, pi of t, x of t, sigma the wt minus the ct dt. And then you see that all those expressions, they always have an x inside. There's an x, there's an x. And then you arrive at that nice equation here. It's exactly the same equation, only reordered it a bit. Here's the r, here's the b minus r. The 1 is just the vector with 1s at each entry. And the nice thing about that is, this is now one-dimensional. There's only one process, x here, here's an x, here's an x. And if you forget about the c for the moment, it's even easy to solve. It's the same equation like a stock price equation. And this is why we will use that quite often. Here's an example, a very easy example. If I have a linear strategy, which means my pi is constant, and I don't say that my pi is between 0 and 1 or whatever, it can even be 5. If I have a 5 here, it means that I have a credit, a negative position in the bond, which is 4 times my current wealth, and I'm consuming proportional to my current wealth. Now if I have 5 here, if I have 100 here or whatever, this sounds quite risky, and it might be. But the point is, if I'm plugging that into this equation, I have an equation which has also here a gamma times x, so there's a gamma, there's an r plus, and so on, and I know how to solve this. That's the solution. And the funny thing is, it's always positive. Yeah? That's the surprising thing. Even if you have a negative position in bond or stock, even if you have a very high consumption velocity, the portfolio process stays positive. That's the difference for a one-period model where you're not allowed to have a negative position, because you can go bankrupt then. And why is this? Well, it's because it's proportional to your current wealth. If your wealth goes down, the amount of money invested in the risky asset also goes down. So everything goes down to 0 if your wealth goes down to 0, so you never get negative. That's the good point. So at least that's an argument for having those linear strategies, and we will see that later on that very often the optimal strategies are of that form. Okay, I will say that a pair consisting of a portfolio process and a consumption process is admissible if the corresponding wealth process, and this is the one that solves equation 3, if this stays non-negative, after we have of course started with an initial wealth which also is non-negative. That's quite natural. You're not allowed to end up with debts. Okay, I think we're now close to the formulation of the problem, and here it is. If we would now say we want to get as rich as possible, then we know that due to the uncertainty in the market, this would only be possible if we would know everything in advance. But we don't know everything in advance because there is some randomness inside. The second idea would be, I want to be as rich as possible in the mean. So maximizing my expected wealth. If I would do that, what I would do is I would invest an infinite amount in the stock with the highest return and would go infinitely negative in the bond. Yeah? And this would generate an infinite expected wealth, but of course this is on one hand highly risky and not possible on the other hand. We have not taken into account any kind of riskiness, therefore one is using a so-called utility function here. And the utility function has some properties. So strictly concave means it's of the following form. Strictly concave means it looks like this. Well, yeah. And strictly concave alone would not say it's like this, because we also have these conditions that u prime of 0 should be plus infinity, so it starts here. That's the condition, u prime of 0 is plus infinity. And we have the condition that u prime of plus infinity is 0. So this ensures that it's strictly increasing, that you prefer more to less, more or less, and having some other properties which I show you in a moment. This is a reasonable function that quantifies the advantages of the investment. And if I have two such utility functions, then my aim is, I'm trying to, well, to feel well by getting rich here, and by living well by consuming during that time. And of course, it would be nice if I could still have an infinite utility, an infinite expected utility, but I should not get this by adding up plus or minus infinity in a strange way. Therefore, I have this strange condition here, and if my utility function is positive, this is satisfied anyway, so you can forget about that condition, more or less. Here are some examples. The logarithm is the most popular one, then the kind of Hara functions here, 1 over gamma x to the power gamma, and gamma is smaller than 1, not equal to 0, but gamma can be negative. Or you have a function where you have an explicit discounting here, as you could say consumption tomorrow is not as advantageous to me as consumption today. And here are some properties. I already told you, more is always better than less. Concavity means the marginal utility is decreasing. And that's also something which is very natural, because if you have just £5 in your pocket and you're on the way to a restaurant and you see a £1 coin lying somewhere, then it's nice you pick it up and maybe you could have a small addition to your meal. If someone who has millions of money on his account and a big cash card with him and he sees that £1 coin, he says, well, the additional marginal utility is negligible because I could hurt myself by just going down and putting this up. So for him, the marginal utility of the additional unit is smaller than for you. Another thing here is, by Jensen's inequality, that's quite important, you have this inequality here, which means if, maybe I should write that down also. The question is, why does the utility function care for the risk? I haven't explained that so far, and I can do that here. If I have two investments, say B1, and this is just a constant. And if I have the investment that leads to B2, and B2 is risky, but B2 has an expectation which equals B1, then usually, if you are not risk-seeking, if they both have the same expectation, you should go for B2 if you're risk-averse. And actually, with my utility functions that I just had, I know the following. I know that the expectation U of B2, this is, by Jensen's inequality, because I have a concave function, this is smaller than U of the expectation of B2, but the expectation of B2, this is just B1, but as B1 is a constant, this is just the expected utility from B1. And so you see, as you're risk averse, you're going for the more certain investment if they both have the same expectation. This is why you use utility functions. They automatically care for you being risk averse. Okay. So, this is my problem I'm going to solve. And what I'm doing now is, at the first stage, I'm trying to tell you about the optimal investment in complete markets, and I'm going to tell you about the Martingale approach to optimal portfolios. And the Martingale approach is based on a very fundamental result, and that is the main property in the Black-Scholes model that allows for a unique option price. It's the completeness of the market. And actually the theorem I'm giving you looks quite technical, but it's extremely spectacular. And I always tell my students it's my favorite theorem. And if they have an oral examination with myself, so I always ask, well, what is my favorite theorem? This is one of my standard questions, and they always know what it is. That's the theorem called completeness of the market. So if you look at its first part, the first part just says, let the dimension of the Brownian motion coincide with the number of risky assets. And then I defined two strange processes. The first one, theta t, is just B minus R, so it's the difference between the mean rate of stock return and the riskless rate of return. And well, one could say, is that big or small? And of course, we can only decide if it's big or small if we know about the variance, the local variance, the volatility. So we have something like a kind of risk premium for stock investment. That's the vector of risk premium. And then we have a process h of t, and that process h of t will play a major role from now on. And that process h of t, well, if there would not be these two things here, then you would just say this is the natural discount factor, right? You discount by the riskless rate. Now, why should you discount by the riskless rate? You usually do that if you go for a credit and you want to make payments in the future comparable to payments today. That is justified if you don't have another alternative. If your other alternative is not only putting your money on the bank account, but also putting your money into the stock market, you should maybe discount with, say, the whole market. There is a market discount factor and not just this riskless discount factor. And indeed, you see there is a minus sign here, there's a minus sign there. It's like a discount factor. And indeed, part A of that theorem tells you, if I'm discounting with h of t, no matter which pi or c, which strategy I'm using, in the mean, I don't get richer than I am at the moment. So this tells you this is a suitable discount factor. This normalizes all your strategies for the future. You can put this even more negative, and I will do that in a moment. But for the moment, just remember that h of t is a random discount factor. Yeah? It discounts with the state of the world at the future time of the economy, and it has this inequality. Now the second part says, if I have a contingent claim, and this means just a random variable which is measurable with respect to the information at time capital T and non-negative, if I have such a random variable there, this B here, and the C, the consumption process, then it says, well, if I have this, then there exists a portfolio process pi such that I can exactly get there. It says, well, these are my wishes. I want to be as rich as according to B at Christmas, and I want to live according to the consumption process C until Christmas. Now, is that possible? And the answer is yes, it's possible, which is a spectacular result. Yeah? Yes, it's possible, no matter what your desires are. But it also says, well, this is even exactly possible if you follow a suitable portfolio strategy and if you possess this amount of money. Yeah? It tells you exactly what you need today, and it tells you that it's possible to exactly reach all your goals if you have this amount of money. And I would like to rephrase that again here. So here there is part A. And you see in part A, I have not told you about any future desired final wealth. There is an X in it, but you can read it in an implicit way. If you want to have a future wealth of B, if you want to live according to the consumption process C, then this is never realizable if this expectation is bigger than your initial wealth. So it puts bounds on your desires in a natural way. Yeah? If this is the case, then forget about living according to C and being as rich as B in the end. So that's the negative aspect of that theorem. The positive aspect is the second one. It says, of course, if this is your desire, C and B, you can realize this. You can get as rich, you can live as well as you want, and there is a portfolio process that exactly leads you there, but you need to have this amount of money in the beginning. So this is very spectacular because it tells you exactly you must have this, and then there is a strategy that you can realize that. That's the good point. That's part B. And there's one consequence of that, and the first consequence is there's the unique fair price of a contingent claim. So this already tells you if you have this B, this is the future payment that you get out from possessing a contingent claim, then the price must be that. And there is no need to switch to an equivalent Martingale measure. Yeah? If you do it like this. Instead of, this is the usual formula, use the unique equivalent Martingale measure, discount by the usual discount factor, take the expectation. So which means switch from your personal view to an objective view. Here you can stay with your personal view, but there is no longer that deterministic discount factor, you need that random discount factor. That's the other way of getting it. But that's just a side note. Okay, so theorem of complete markets simply means those two things. And as I had already showed you that you can use that for pricing contingent claims, now there is the second application, and that second application is the so-called Martingale approach of portfolio optimization. Now, the Martingale approach, before I explain that to you, can be visualized in the following way. Now, if we don't have consumption, then this is my time axis. Then I start here with an initial wealth of small x. And now, this here, this is my desire. Here, at that time, there is the final wealth, and I would like to get there, and I would like to have a distribution on that final wealth, which is maybe like this, right? So that's the mean. This is my aim, and the Martingale approach will say, well, before you think about trading, just figure out what the optimal final distribution is. Yeah? So first, find the optimal final distribution. Among all those that you can afford, that's important. So among the affordable, if you have done that, then the completeness of the market tells you, okay, I figure out that. Then in the second step, then find the strategy pi star that corresponds to that optimal final distribution. So then find the corresponding portfolio process. And why is this nice? Well, it's nice because if you think about the portfolio problem that we had, this is a dynamic problem in time. You're not maximizing over one parameter, you're maximizing over a lot of decisions. So if you have this here, then you see that the portfolio problem, this one here, the dynamic portfolio problem, and just for ease of exposition, I forgot about consumption. This portfolio problem really is, think about how to invest in an optimal way at each time instant between time 0 and capital T. Yeah? You have to think about that pi at each time instant. And what we've now done with this picture here, we have decoupled between thinking about the decisions on here and thinking about the end. We first think about the end, finding out the optimal distribution, and then when optimality is done, we think about how to get there. That is the Martingale approach. So decompose this problem into a static optimization problem, no more process here, only random variables, and these are the affordable ones due to part A of the theorem of complete markets. And after I have found the optimal solution, B star, then I think about the corresponding portfolio process, and this exists according to part B of the complete markets theorem. Okay, so what I have to do then is, I have to solve those two easier subproblems, O and R, instead of P here. Okay, so let me maybe try to give you an intuitive idea how to solve that problem here. Yeah, because it's still not clear how to solve that. You have a family of random variables, and how should I solve this problem? Now, first of all, what can easily be said is the following. This is positive, this is positive. This is monotonously increasing. So it will not be optimal to have a final random variable such that we have an inequality here. Because if we have a strict inequality, we just multiply by a constant to get equality here, and then we get a higher expected utility. So we could think about that we have an equality here. And so I'm trying to write that down here. So I would like to solve the following problem. Maximize expectation u of b over all b's which are affordable. And for the moment, I just look at those b such that I have the expectation of h of t times b equal to x. I can afford all those as I have the initial values of x. Now, if I forget now that these are random variables, if I treat them as they are usual variables, I could try to have a kind of Lagrangian approach. And this Lagrangian approach would be like that. Look at a function f b comma y, which is the expectation of u of b minus y multiplied with x minus h of t times b. Now, this now is a function in two variables. We know how to maximize such a function if it is, well, say concave, which it should be, because u is concave. We just take the derivatives with respect to b and to y and set them equal to 0. Okay, so 0 equal to f, derivative with respect to y. Well, that's easy. This is just, well, x minus expectation h of t times b. Maybe I got the minus wrong, but as it's 0, it doesn't matter at all. And if I'm just formally taking the derivative with respect to b, and I assume that I can interchange expectation and differentiation, then I got it like that. Let's do it like this, that's easier for me. Minus y times h of t. And now I'm trying to solve this by using this here. If this is 0, then the expectation is 0. So I'm just trying that. So I'm trying to have a b, which is the inverse function of that, of what you have here, yh of t. So this is something like a b of y. And I plug this into the first thing. And I have to have this here. So what I need is, I need that x equals the expectation of, let's say this is, I call this I. This is I of y of h of t. And then I call this script x of y. And now you see what I have to solve. I have to solve for the y here, and just do that here. And then I get y of x being the solution of that. And then I get my candidate, b star is just I of y of x times h of t. Okay, I did a lot of heuristical stuff. I didn't do that in an exact way, and if I have to justify that, it will be extremely hard for me. Because what I have to do is I have to justify that I can interchange here expectation and differentiation, that this function here is strictly increasing, that it has a solution, and so on, that the final Wells is non-negative. This is okay because I is a non-negative function. But I also need that y of x is positive, and so on. So I did that just for motivating motivating my result that comes in a moment. And my result that comes in a moment is the following one. So here's my theorem. My theorem says, if I'm going back to include consumption, then my optimal final wealth is, I'm taking the inverse function of the derivative of the second utility function, applying that to y of x times h of t, c star, this is y1 t yx of h of t, and I believe that I never told about, so the I1 and the I2, they are the inverse function of the derivative of U1 and U2. This is, which is simply missing on your slides. So I have it here. So I1 of t, comma c, this is just U1 derivative with respect to c, and simply the inverse function of that. And I2 of x, this is, well, U2 prime, the inverse function of x. Sorry, this is what I forgot on the slides. So if you have this, then you get this very, very explicit formula here. And why is it so explicit? Well, I2 is known, I1 is known. H of t is given. H of t, you know, this is that process here. And r, theta, they are all known. So you have a very explicit result here. The only thing that you do not know is that number, that constant y of x. Okay, and also I can show you that there exists an optimal strategy. Okay, now, I can specialize this to the case when I1 is 0 or when I2 is 0. So I could have optimal consumption and optimal final wealth. These are just these two corollaries, or these two parts. If I don't have utility from final wealth, then still this is the solution, but I end up with a final wealth of 0. If I don't have utility from consumption, then still this is the solution, and I end up with that final wealth. Now, these are quite abstract theorems, and therefore I think it's necessary to have an example. And I think I need 5 more minutes for the example, and then I make a break, right? Okay, so I just give you the example because in my theorem I told you there exists an optimal strategy. I haven't computed that. So here we are. Let's look at the logarithm. And at the logarithm, we can calculate everything in an explicit way. And this is what I want to show you before we make a short break. Okay, with the logarithm, we're maximizing expectation logarithm x pi of t. So u1 or u2 is ln of x. So what do we need? We need u2 prime of x, which is 1 over x. Then we need the inverse of that. Now what's the inverse of 1 over x? That's one of the main sources of questions. It's 1 over x again. What else do we need? We need this script x of y. What is this? This is the expectation of I2 of y times h of t multiplied with h of t. Now that's easy because I2 is 1 over, so the h of t cancels out, so it's just 1 over y. Okay? Because the h of t cancels out against that h of t. Now from that we get, if we set this equal to x, then the y of x, the solution, is just 1 over x. But then we get the b star, which is I2 y over x h of t. Now what is this then? I2, again, is 1 over, so the 1 over x is an x here, and the 1 over h of t, well, this is just 1 over h of t. Still in time? Okay. So you see, These are very easy calculations, right? There's nearly nothing to do. It looks complicated in the theorem, but if you do it for the logarithm, here I found exactly my optimal final wealth. Okay, so if you're going back to the PC, so I've computed all those things in an explicit way. And now the question is, how do I get the strategy? So I've plugged that in. This is x times 1 over h of t. Now I have it like this, and then I make a very, very simple trick. I want to write it as a stock price, as a solution of a stock price equation, which is r minus sum squared, so r minus 1/2 squared here. Therefore, I'm adding the theta squared, and I'm subtracting it. But now from this I know exactly what's the outcome. And why do I know what's the outcome? Well, you know that if you have something like x of t equals x times e to the power a minus 1/2 b squared times t plus b wt, then you know that the equation that you have, dx of t, is just a times x of t dt plus b times x of t dwt. But with our Wells process, we had an x of t, which is r plus pi t times b minus r dt plus pi of t sigma dwt. And now it's easy to equate this with that, or equate this with that here. They are the same. Solve this in this equation here. And then you get pi of star of t is just b minus r over sigma squared. That's it. And b minus r over sigma squared is a very simple result, because whatever you think about that b minus r over sigma squared, the nice thing is it's constant. It means always have 60% of your wealth invested in that one stock, 40% of your wealth on the bank account. It's very explicit, right? Very explicit here. And even if you are in a d-dimensional setting, oops, sorry, you get this result here, and you get that result also if the coefficients are deterministic, if they are slightly stochastic, you always get this result in the log utility setting. Okay, so I think we make just 5 minutes break, and then we continue after that. Okay, thanks for the moment.